My name is Muhammad ZAFAR FARIDUDIN bin RAZALI, and my matric number is 060656. Today, I would like to present about the abstract. First of all, this study used the statistic technique to give actual finding on Islamic bank credit risk management. The findings demonstrate that several financial institution characteristics have a considerable impact on Islamic bank credit risk. According to the Declaration of Ownership, there is a substantial difference in this regard among locally, internationally owned by Islamic bank. A multiple of credit risk reduction strategy and instruments have been created during the centuries of traditional banking practice, and the process of their evaluation is still ongoing owing to rapid change in the banking industry. As a result, they are usually obligated to adapt traditional procedures which have limited application in Islamic banking because of Sharia non-compliance, up with different methodology or the approach in which they are carried out in traditional banking. For the introduction, Islamic bank finance have been a worldwide trend since their introduction in 1975. It expanded from a localized issue to a worldwide one. Islamic bank finance are still potent and growing over the world, and they are focused on early credit research, especially in wealthy nations. Credit risk management has a long history that dates back to prehistoric time and the earliest significant civilization. The first mechanism for mitigation credit risk impact were already in use during the time period. Islamic banks were unable to engage in traditional finance. They focused on a range of Sharia compliance business. Credit risk is described in Islamic bank as a danger that a buyer may be unable to pay the agreed upon installment or will abandon the business sooner than expected. I will continue with the research methodology. First of all, the effect and causes on credit risk in Islamic and conventional bank were determined using a multivariate regression analysis. To gain a better grasp of the issue, we initially relied on secondary data obtained from online research and website visit. Secondary data is drawn from a journal article, website and conference proceeding. This article evaluates the current literature in the part of this and describe interpretation of the outcome of credit risk management for Islamic bank in order to come up with findings that are appropriate to the research and credible enough.
My name is MOHD Hakim my surname is 067355. I want to present about literature review. Firstly, is a bank credit risk is meant as the gain that a customer of the bank will default on the loan. However, the Islamic bank take the part of settlement of the payment risk that occur when a certain party to a commercial transaction that they have to pay money. For example, SAYID or Wahid contract deliver asset murabahah contract before get its own asset or cash that exposing it to a possible to loss. Secondly is a multitude of credit risk mitigation technique and instrument have been created during centuries of traditional banking practice, and the process of their changing is still ongoing due to a rapid evolution in the banking industry. Islamic bank, on the other hand, have yet to establish sufficient legitimate Sharia acceptable credit risk management strategy to suit their needs. As a result, they are frequently obligatory to adopt conventional approach which have a limited utilization in Islamic banking institution and to a Sharia non-compliant of the particular method or the manner customers are executed in conventional banking. Credit risk is one of the highest mudarabah and also musyarakah financing in Islamic banking. For example, mudharabah financing is investment expose the bank to the traditional principal agent dilemma while also resulting in increased credit. The mudharabah is imperative from because of the nature of the bank is bare for participating in the mudharabah deal. As a result, assessing and evaluating the project is challenging. Many people, particularly in wealthy countries, have been interested in credit risk management study. They determined that credit risks in the banking sector are significant not just for management in banking but also to regulatory bodies. Lastly, its risk vary depending on the type of the risk determinant. Loans are the determinant of the market risk exposure. The value of capital financing expansion and financing concentration are all factors to consider. Two variables that hold true for unsystematic risk, while financing expansion and financing are replaced by short-term in interest rate concentration.
Assalamualaikum warahmatullahi taala wabarakatuh. My name is Muhammad AZHAD bin FIRDAUS. My ID number is 060147. I will present about the finding that we found, which is the factor that influence credit risk in Islamic banking. The first finding is management efficiency. Management efficiency has a significant relationship with Islamic banking. According to Hassan 2003, Islamic banking less efficient in making a profit, as the research resulted that banks that are bigger and have a higher profit rate have higher efficiency rate. According to Gale, low level of efficiency, the bank or financial institution is faced with the problem of potentially creating a situation of loss and waste of resources in organization. From this statement, Islamic banking likely have a low level of efficiency than conventional bank, because it is related to the principle of Sharia to avoid interest. For example, the earning assets are largely on murabah and mudharabah mode of financing. When the credit risk is transferred to its investment depositors and the loan default are not recognized, that's why it will result the higher of credit risk, different from conventional bank that all interest based in conventional banking and loan default is immediately recognized after 3 months of arrears interest. What we can conclude is every action or decision of the bank is managed by the management team. Since managing credit risk in Islamic banking require a different approach that caters for its unique bank operation, management such as risk managers need to evaluate effective strategy, for example, reduce adverse selection and strengthening internal control to increase the effectiveness of mitigating credit risk in Islamic banking. I'm done with my part. Next, Mr. Irfan will explain the second finding. That's all from me. Thank you.
Hi and Assalamualaikum. My name is HARRAZ. I'd like to continue this presentation by suggesting other findings that our group have initiated. The second finding is called risk-weighted assets. Now, let me briefly explain to you in 5 key elements so that you can understand what risk-weighted assets is. Firstly, risk-weighted assets, also commonly referred to as capital requirements in the financial institutions. Secondly, this mechanism of gambling mainly functions and helps financial institutions to reduce the risk on insolvency. This is done by determining the minimum amount of capital that must be held by banks. Moreover, as we're talking about how Islamic banks should handle its credit risk, thus it is only appropriate for them to only focus on Sharia-based products like mudarabah, musharaka, murabaha, and others in line. Finally, in most countries, and especially in Malaysia, the central bank requires other banks to maintain a minimum amount of 8% in their capital adequacy ratio, or CAR. Now that we have a brief idea about what risk-weighted asset is, we will now look into how exactly bank operates and uses risk-weighted assets in their operation. The bank will simply recognize the type of assets and classify each type of asset to its group. For instance, an asset that has no collateral means that it will potentially brings along with much higher risk together. Now that they recognize in unsecured loans that are not backed with any collateral, they know that will harm lender with risk being implied, especially of default payments thus would directly be given a high weightage of risk. This mentioned type of assets will typically come with higher interest rates for its borrowers. On the other hand, those product that comes with collateral behind is less risky and is weighted much lighter. With that being said, this suggestive alternative is a good choice for every Islamic banks to implement to ensure their good management of credit risk.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Arif HAIKAL bin Muhammad SHUBRI. My metric number is 059713. Now I'm going to share the last finding in our study is size of total asset is impact to the credit risk in Islamic bank. First, we use the credit risk as the factor and calculate as the provision for damage to loan divided by the amount aggregate credit. And this ratio is related to the allowance for non-performing loans to outstanding debt, and for the proportion of asset value is used to determine the growth in Islamic bank. Next, the investment portfolio and its funding business can lower the exposure of risk as the major banks can be more flexible, and the credit risk increase when their capitalization sufficient and optimized resource size is diminished. And lastly is Islamic banks may decrease or limit significant currency risk using a well-structured, excellent risk evaluation and proactive methods. And this is due to the bank capacity to reduce lead costs through economies of scale and leading to increased productivities. What we can summarize from the last finding is the total asset has an adverse and sustained influence. The finding also demonstrates that there is a residual among asset sufficient and liquidity risk, and it is suggested that Islamic bank can expand their capacity in order to reap the advantage of diversity, and this would multiply the effect of the development of accelerate and influence the amount of credit quality as well as other form of hazards.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad SHAHJAHAN bin Syed KASSIM. We have reached the end, which is the conclusion. Despite the fact that credit risk is the leading cause of Islamic bank failure, it ranked lower than other risks faced by Islamic bank. Islamic bank rely on regular hedging product because not through Sharia compliant credit risk management instrument exit. This is not the case with a credit securitization and derivative, where adjustment must be made such that only the application effect is the preserved while all other components of the transaction are altered. Islamic banks may draw on their conventional banking skills when analyzing and processing loan requests. However, Islamic bank must exercise part of something large in this process, particularly when dealing with equity investment, because there are significant information asymmetry problem, and banks have limited influence over the implementation of sponsored project and effective risk management. Islamic banks, such as conventional banks, earmark certain provision to safeguard their business, shareholder interest, and in particular investment depositor. Due to religious restriction, Islamic banks are unable to enter the standard banking sector. Nonetheless, mainstream banks provide Islamic goods alongside their own. In this regard, more equal competition between Islamic and conventional banks can only be realized if Islamic banks share identical infrastructure institutions. A risk management culture must be formed in Islamic bank. The implementation of such as technology can assist in filling gaps in risk management system, hence enhancing regulatory and external credit rating agency ratings. That's all from us. Thank you.